as a buyer, you could come to UK Export Finance. You can do that directly coming to me.
I'm joined by Graham Scopes, a true veteran of international finance.
And we can support the financing for up to 85% of that contract value.
But the companies will go through a rigorous process to be eligible for the ECA.
And we can do that for a tenor of up to 15 years.
Wow. Graham has built a reputation with over 35 years in banking and nearly 3 decades in the Middle East.
We offer supplier credit products that enables us to support 80% of a transaction. So we can multiply the limit that your bank gives you by 5.
This is something you cannot see with traditional banking facilities. Graham, thanks a lot for joining me today. I really appreciate it. First, let's start for all the treasurers who don't know what an ECA is by defining what's an ECA, and then we can move further from there.
Okay, so an ECA is an export credit agency. This is an agent of the government in most cases. Sometimes it is part of government. Sometimes it is a ministry type structure. Sometimes it's a government owned company. And the export credit agency does what it says on the label, exports. It's about promoting exports from the country which the ECA represents. I work for UK Export Finance, which is the export credit agency of the government of the United Kingdom of Great Britain and Northern Ireland. And we are the oldest export credit agency in the world. We're founded in 1919, just after the First World War. So we're 105, 106 years old now and have been helping to promote exports from the United Kingdom for all that period.
Oh, that's interesting because the name might be a bit deceiving when we say export credit financing. That means we are supporting the exports, but this does not necessarily mean that we're only supporting the exporters. Right. So maybe we need some clarity there because people might think, okay, I'm not exporting from the UK. Maybe I'm based in UAE and I'm importing from the UK. So where does this...
Correct. So it's a little bit of a history through this. So I'm going to take you through that. So the Export Credit Agency, when it was originally founded, the United Kingdom, we were supporting British contractors that were going overseas to build ports, rail, airports, infrastructure of all shapes and sizes. And so over that sort of 100 years of history, that was the original purpose, to support UK contractors doing projects overseas. It was bringing revenues back to the UK and it was developing projects overseas. Now, the world has changed. So the sort of contractor that the UK had, back 50, 70, even 20, 30 years ago is very different to the sort of companies that exist in the UK today. International companies from elsewhere around the world are much more competitive. They have lower cost of labor. They have different situation. And so what export credit agencies do now, at least in the case of the United Kingdom, is we support the what and not the who. So it is not about a UK contractor. It is about content from the UK. We can go into the content in a moment. So an ECA can now offer cost-effective financing. It can typically offer longer tenor financing, which is attractive to treasurers, of course. But it is binary. There has to be the content from the UK. So unless there is the content, no matter how good the project, no matter how strong the cash flows, how low the risk is, we can't help unless there is the export content from the country that an ECA represents. So most major countries have an export credit agency. Around Europe, pretty much every country has an ECA. Americans, Japanese, Koreans, and so on have one or more ECAs. Even here in the Gulf, there are export credit agencies. They're relatively young. Etihad Credit Insurance here in the UAE, for example, is precisely 100 years younger than UK Export Finance.
Wow.
So we had the privilege to help give them some guidance, give them some advice, give them some assistance when they were setting up an export credit agency here in the UAE. So any company exporting from the UAE can take advantage of the support that they offer. We'll come into what those supports look like in a minute. Saudi has an export credit agency as well, Saudi Exim. So it is not just something that's sort of old school from, the leading international Western economies. Pretty much all countries have an export credit agency, all countries that want to export goods.
So to briefly summarize it. So an export credit agency does not just support the exporters of the country, they support anyone importing from this country, sorry, as long as the content, or there is a specific percentage of the content that you are buying is from within the country.
In the traditional export credit agency, yes. So let's explore that. So we have two toolboxes as UK Export Finance. Other ECAs are very similar, but obviously my points of reference are UK Export Finance. So we have a toolbox which is focused on overseas buyers, so importers in this case, and we have a toolbox that's focused on suppliers from the UK, exporters from the UK. So let's start with the traditional, and then just briefly explore the supplier credit side as well, because it is relevant, because there is a very large number of international companies that have presence here in Dubai and in the UAE. And a very large number of those companies put their business development, their sales functions for the region here. So we go into that side of it a bit later. But let's start with the way that export credit agencies have evolved, helping overseas projects, helping develop still the big infrastructure, but beyond that, there's a lot more flexibility to how it can be used now, because it's coming from the what and not the who, which is the crucial point to look at. So here in the UAE, let me give you some examples first of all. It'll make it a bit easier to understand. Here, since the financial crisis, so since 2008, UK Export Finance has supported 11 projects here in the UAE. Now, that may not seem many in terms of large buyer credit, but it's actually more than any other country in the world, which puts it in perspective. We've supported projects in close to 200 countries. So 11 here is significant from that point of view. So what are those projects? These are facts. This is a matter of record. You can find it in our annual report. So I'm not giving anything away that I shouldn't. So we have done 4 projects with Dubai World Trade Center. The offices at Dubai, at One Central Dubai, the offices 1, 2, 3, 4, 5, the 25 Hours Hotel, and the Ibis Hotel alongside the exhibition halls. We supported those in 4 phases of financing, a total of $600 million. We have supported 4 separate projects for Miras as well. So this was Miras when they were an independent company, Dubai Parks and Resorts, Blue Waters Island, Coca-Cola Arena, and City Walk. $800 million worth of support across those 4 projects. We have supported 2 financings for Beer Group in Sharjah, the Sharjah Waste Management Company. Their beautiful Zaha Hadid designed renewable energy powered headquarters building. We supported that with 2 financings, total of £100 million. And then most recently, and this started before COVID and finished after COVID, was the Jumeirah Marsa Al Arab Hotel, which was completed and opened in March of this year. £366 million of support for that particular project. Honestly, when I joined UK Export Finance just under 4 years ago, if somebody had told me that between 30 and 40% of a luxury hotel on the beach in Dubai came from the UK, I would not have believed it. I would have lost that bet. But it's true. I've seen the facts. I've seen the figures. So the content for a project can be found. And we, as UK Export Finance, the other parts of the British government, can help you find that content. Again, I'm using the UK as an example, but in the interest of objectivity, the same would apply to the French, the Germans, the Italians, the Americans, the Japanese, and so on, the other countries with ECAs. They will help you find the content from their respective countries.
Makes sense. So let's go in a bit into the details. Let's say now I'm an importer, or I'm building a project here in UAE or any of the Middle East countries or the GCC. And the content I am buying to build this project is coming from the UK, for example. Okay, let's go step by step. What's the condition for me to be able to approach UKEF and ask them for financing? Is there like a minimum percentage of content I need to be buying from the UK for this project? That's one question. And then we go.
There is a maximum, that's 100. And we have a minimum, which is 20%.
20%.
So let's go into the examples. So there are 2 examples, and I want to distinguish between the 2. One is a project, and the other is a procurement. So let's start with a procurement. You can be a company here and you're looking to buy 100 JCBs or,
Mm.
100 Jaguars or 100 whatever from the UK, something that's very easy to conceptualize. It's not the complexity of a project yet. Um, and so in that case, as a buyer, you could come to UK Export Finance. You can do that directly coming to me. You can do that through a bank, which is perhaps the normal way that we are approached. You talk to your bank and say that you're looking to raise finance to this purchase of 100 whatever from the $100 million from the UK. And we can support the financing for up to 85% of that contract value. So um, in the case of this purchase, we can support up to 85%, and we can do that for a tenor of up to 15 years.
Wow, 15 years.
15 years is the maximum. Now, obviously, it would be constrained by the useful economic life of the asset. If you were buying Jaguars to sell to people, then probably it wouldn't be a 15-year financing. But if you're purchasing goods from the UK, whether it's specifically for a project or not, then we can do up to 15-year tenor. So now let's look at a project finance. And here, let's take a power project, for example, a renewable energy power project, something like that. Then here, what you would do is, as with any project finance, your borrower in this case may be an SPV. It may be set up so it doesn't have that balance sheet that enables us to look at the procurement in its own right. So in this case, the proxy for the credit would be the offtake of the power. So the power would be sold to a TACA or a DEWA or a state utility that's relevant, and they would provide effectively the credit support in terms of the long-term take or pay offtake agreement. Classic, simple project finance. And then, so the first thing you would do, depending on the volatility in the cash flows, is you'd size the debt to equity. So different industries have different levels of leverage. So in the same space we're talking about, in a power project or a desalinated water project, that would probably be something like 80-20, if not a higher amount of debt. So you size the debt, you size the equity based on the cash flow volatility, and then we could support up to 85% of the debt in that example. So if the whole project was 100, it was 80-20, we could support the financing of 85% of the 80.
So that's very interesting. So obviously, the leverage accepted for each industry is different. And just to make it clear, UKEF or any ECA would go through a proper credit review of the project and the company requesting the facility or the financing or the support. Now, let's go through the process. So let's say I approached one of my banks for the financing through an ECA, let's say UKEF. Then what's the process timeline? I know it can be lengthy because I've went through a couple myself, but I think the interesting part here, which for most of treasurers and the CFOs, is the cost of it. So
Okay.
if you go through, I don't want to call it pain, but if you go through the time and you invest the time and the review and the credit review for the ECA, it is worth it. That's from what I have seen so far, price wise.
Yeah.
So maybe let's go through the process for the timeline and how you review the credit worthiness of the company and the project,
Yeah.
and then we can go through the details of okay, what are the associated costs for this
Sure,
facility?
no problem. So let's look at about the eligibility, and then we'll slightly get into that.
Yeah, for sure.
So the eligibility, and I think this is where the UK has a good advantage. We talked about needing to have consent from the UK, that being binary, this yes or no. But when you look at consent from the UK, and I'll come back to the Master Al Arab project as an example, consent can be goods, consent can be services, consent can be intangibles. So let's go backwards through those. Intangibles is things like licenses and intellectual property. So if you imagine a university, a school, a hospital, so these are not necessarily real examples, but a University of Birmingham, University of Manchester, University of London, whatever, University of Cardiff, coming here, they're bringing their educational model. Same for a hospital. Guy's, St Thomas's, Moorfields, whatever. They're bringing their model here, and they might get paid a royalty for doing that. So it might be $1 million a year for 10 years, example. So that 10 million can count towards eligibility for UK export finance. That's the intangibles. The second part is the services. The UK has a global advantage, I think, when it comes to services sector. So right from the very beginning, before your project is a project, you're perhaps doing a feasibility study. You're going to use maybe an Ernst & Young, a PwC, a Deloitte, a KPMG. You're going to maybe do some environmental due diligence. A lot of the companies that do the environmental social impact assessment reports are British as well. So the cost you spend on those consultancies that you're going to do for a project anyway. Now, of good fortune for the UK, a lot of those companies are British companies. That cost can count towards eligibility. Moving beyond that, design. From your first conceptual drawings of design, I mentioned the Zaha Hadid designs, BIA headquarters building. So from the very first drawings, in the back of a pad somewhere, to detailed drawings before it goes for engineering, there's a lot of design companies from the UK, some very successful ones involved with, for example, the infrastructure, the metro, the rail here in the UAE active at the moment. Moving beyond design, engineering, from your front-end engineering all the way through to your final engineering. Pick a British company, you're starting to create eligibility for UK export finance. International projects, international contracts is very often documented under English law. Nobody wants to pay the legal bills, but when you do pay the legal bills, assuming you use a British solicitor firm to provide the legal advice and to do the work, then those cost of the documentation can count towards eligibility of UK export finance.
And can I combine a couple of those?
All of them.
So let's say I had a designer from the UK, but it's not up to enough to 20%. But then I got the solicitor, the legal.
Yeah.
Now both of them are combined 20%.
You combine your intangibles, you combine your services, you combine your goods. And I haven't finished on the services yet.
I didn't know that. It's very interesting.
It is. And this is why I think we have a good advantage, because no other country has the full spectrum of services that the UK offers. So the eligibility can be achieved more easily. Not only we start at a lower percentage than many ECAs at 20%, but you've got all this services envelope as well. So just to finish that, insurance. So a lot of international project insurance finds its way to the Lloyd's market in London. So even if you're obliged initially to insure in country, in Saudi Arabia, for example, you have to initially insure with a Saudi insurance company. If there is 90% reinsured in London, then that cost of the insurance can count as well towards eligibility for UK export finance. And finally, marketing. You might use, one of the big UK-based marketing firms to promote your project, your 5-star hotel or whatever it might be. So all of that services envelope can very easily, in the total project cost, be somewhere between 10 and 15%. Wow. So you're halfway to the minimum 20% that we want to see very easily by some informed choices of high-quality companies anyway that I've mentioned when you're developing your project and work that you're going to do anyway. And we even have a new product. It was launched late last year called the Early Project Services Agreement. So your feasibility study, before your project is a project, then we can provide funding support to enable you to cost-effectively borrow, rather than spend equity, to cost-effectively borrow to fund that feasibility work when it's through a UK company.
Wow, that's
so that's new product. So putting all those together, we've looked at the intangibles, we've looked at the services, and then there's the goods. And so the goods don't, in today's supply chains, not everything typically comes from one country. You might buy a box, a computer or whatever it might be, and part of it's made in the UK, part of it's made elsewhere. And that's fine, as long as there is a minimum of 20% real UK content in those goods, as long as it qualifies for a certificate of origin for shipping out from the UK. You can't ship something in, stick a flag on it, send it out. That doesn't work. But if the in-country value in the UK from the fabrication of those goods or assembly of those goods, however it's put together, is more than 20%, then it can count towards being a UK good. So there is a lot of flexibility there. And I want to be very clear, it is not just a UK company. It can be a overseas company that is operating in the UK. A couple of easy examples. Alstom is a French company, but they produce trains in Derby. So if they use their factory in the UK, then we can actually support exports by Alstom from the UK. Similarly, Siemens, they produce in the UK as well. GE has factories in many countries. If they are exporting from a factory in the UK, then we can support that as well. And in fact, I mentioned Etihad Credit Insurance earlier, the UAE's export credit agency. The first deal they ever did was in collaboration with UK Export Finance. And this was exports from GE in the UK going to Iraq, some spare parts for power stations. And the goods were shipped to Jebel Ali. And then GE in Jebel Ali enhanced those goods, finished those goods, which created the eligibility for ECI. And then the goods were shipped to Iraq. So that's an example. So goods and services and intangibles, put the components together and you get eligibility. So I mentioned 11 projects earlier that we had supported. And for every single one of those 11 projects, every single one of those financings that we did, we achieved in total between 30 and 40% UK content. So the big envelopes in Master Al Arab, the most recent one, is services. We've already talked about that. The combination of services, some wise choices about what are the consultancies, who are the designers, who are the engineers, etc. The next biggest envelope is mechanical, electrical, and plumbing. So the UK has a very strong supply chain when it comes to MEP. And so in aggregate, more than 10% of the cost of that particular project came from the UK as MEP. And thirdly, the other big envelope, also around 10% or so, is the high quality furniture, fittings, floorings, things like that. Again, I'm not particularly telling you anything other than facts, but Jumeirah, whether you go to their hotel in the Maldives, Dubai, or London, the touch and feel that they have in the bedroom, the corridors, the lobby, wherever, they've chosen products that come from the UK. And so that envelope is large. So you might not have thought, I wouldn't have thought that from the UK, you'd get a third or more of the content coming from the UK. But without going out of your way to buy things that you're not going to buy anyway, high quality, cost effective goods sourced from the UK, more than 20%. Obviously, we try and achieve as much as possible, but we won't break a deal by saying it's got to be 31 or 32 or 33%, as much as we reasonably can get as content for the project. And that will vary by industry. And then that creates the eligibility. And so what are the benefits of that for the treasurer? What's the benefit of that for the company? So the two obvious examples that people talk about are cost of funding and tenor of loan. So let's deal with the tenor of the loan. That's the easy one first. So since July of 2023, the OECD arrangement was revised. This is the framework agreement between OECD countries about what they can offer. And the reason this framework...
Do you mind if you elaborate more on the OECD countries?
Yeah, Organization of Economic Cooperation Development, I'm not sure, OECD. So this is the framework between, it's about 30 countries that stops a spiral to the bottom. It stops the UK saying 10 years, France saying 11, Germany saying 12. There's a framework agreement that controls the tenor and looking at the risk rating of countries influences the pricing that can be offered. So it stops a spiral to the bottom and unsustainable lending being offered to countries, which will only hurt the recipient. They may think they've got a great deal, but if they've got too much debt, it's going to only cause problems that come back and hurt later.
So they set the standards for what's the acceptable tenor for an acceptable risk level.
So so all ECAs that are part of the OECD countries. So that's all of the ECAs that we've mentioned in terms of the European, the Asian, the Americans, etc. Some of the local ECAs are not part of this OECD arrangement, so they're not necessarily governed by it, but they tend to follow the OECD rules, even though they're not required to do so as a matter of practice. So we can now do construction plus 15 years for any industry. And if it is something that falls under OECD's definition of climate change projects, so there's a climate change sector understanding, and that there we can do construction plus up to 22 years. So for projects that are in clean transportation, renewable energy, water and wastewater, there's a lot of definition, but simplistically, those 4 segments, we can do construction plus 22 years, which makes it very attractive for large infrastructure projects. Again, we talked about metro, we talked about rail, we talked about airports. There's a great example, hopefully coming up in Dubai soon, where hopefully we'll have the opportunity to support some of the Al Maktoum International Airport project. So that's the tenor. So that's, different borrowers can achieve different tenors from their banks. Previously you'd have talked about 7 to 10 years, maybe as a maximum for corporates. The current liquidity in the banking system is meaning that the banks are going longer for certain projects and certain borrowers, but not necessarily everybody. But everybody can, subject to the due diligence on the project and the appropriate risk profile, have up to construction plus 15 years under an ECA supported facility.
This is something you cannot see with traditional banking facilities.
But banks are not yet going that far generally, but there are examples. There are examples that you will find that have been done recently. Hafit Rail, the rail link between Oman and UAE. That one achieved 15-year financing on a non-ECA transaction. So the banks are stretching the tenor.
These are exceptions.
These are, I think, exceptions.
This is definitely one of the main competitive advantages when you go to the ECA. The tenors.
There are 3: tenor, price. We'll come to price, and I think there's another one which is probably not as easy to understand, and that is discipline, because there is a financial discipline by having a project that is reported to an overseas government. So when you're the C-suite, when you're the CEO, when you're the CFO, the project that you're about to embark on is probably the most important thing. You're answerable to the board for the successful delivery of your project. But once you've signed those documents, once the project construction starts, you have a project manager that's running it. Maybe you're even your treasurer that's running it. But
it's usually this way. It's usually
when you're the CEO or the CFO, how can you be sure that the project manager is going to tell you if things start to go off track? If the construction schedule or the budget isn't working, how can you be sure that your treasurer, of course they would, is going to tell you when things are not working exactly the way it should? So the fact that you're getting a report from the Export Credit Agency, probably to the CEO and the CFO, it helps to keep visibility on the project from an outside source as well. So I think there is a sort of an inherent financial discipline to a project that's done under an ECA. That's not necessarily a reason to do it, but it's a hidden benefit. So let's get to what you're really asking about, which is pricing.
Yeah.
So the cost of an ECA forms 2 parts to it. So there's the part that goes to the ECA, which we call the export premium, the insurance premium, the risk premium that comes to us that covers our cost of providing the service. We don't lend to make money. We don't support lending to make money. We support that financing to drive exports. That's the only reason we do it. But the way we do that, mostly, there are some exceptions. We do a little bit of direct lending, but mostly we do it through guaranteeing a bank, because a bank's job is to lend money. So what we do is we de-risk the transaction to the bank and that they provide the money. So in this case, the bank, the margin that is paid goes to the bank because they're lending the money. The bank is likely to charge an arrangement fee to put the transaction together. So let's look at the bank side of the cost, and then let's look at the export premium side of the cost.
Yeah.
So on the bank side, let's come back to what we were talking about earlier. 85% of the transaction risk, 85% of the procurement, or 85% of the debt, depending on whether it's a project or not. So that part The part that we are going to stand behind, we're going to stand behind with a guarantee. We don't do insurance, we do a guarantee. So it's an on-demand guarantee from the governments of Great Britain and Northern Ireland. So that's a pretty strong guarantee. Um, so that guarantee means that the transaction is de-risked. They're no longer taking the project risk. They're no longer taking the risk of the purchaser. They're taking the risk of the government of the United Kingdom. So the long-term credit pricing of the UK, it will vary a little bit by currency. It will vary a little bit by tenor. It will vary a little bit by market circumstances. But the smallest margin I've seen is about 0.6, 0.7, so 60, 70 basis points. And the highest margin I've seen for long tenor UK government risk is about 1.3, 1.4. So if you're talking about 1% plus or minus, that's the envelope we're talking about as the margin. So if you have got construction plus 15-year money at approximately a credit spread or a margin of around 1%, that's pretty attractive to most treasurers.
Great news, guys. We're partnering with the Association of Corporate Treasurers. So stay tuned because a lot of exciting content coming your way. Yeah, definitely. From what I have seen so far, there hasn't been an ECA that I've been involved in that wasn't at least 200 basis points cheaper than if you go through a normal banking. And going back to the other challenge that you face with the tenor, getting a tenor to finance this facility, and the amount of convincing that you need to do with the bank to get this done in place. And it's very hard for you to find this type of financing for this huge project for this tenor at this competitive pricing. And just on the point that you mentioned before, the pricing for the reporting that we provide for the ECAs, for them to be comfortable that this project is going well and ticking all the boxes, we do go, or the companies will go through a rigorous process to be eligible for the ECA. So what I want to say is, for treasurers, don't hesitate into going through this process and thinking, okay, this is going to take too much work, etc. Because the pros that you're going, or the pluses that you're going to get out of this, are way, way more valuable than the pain they're going to go through.
Yeah, we'll come to the process in a minute. Let's just finish on the pricing.
Yeah.
So we talked about the margin that goes to the bank. They provide the money. UK Export Finance can support loans in 60 different currencies, including dirhams, including Saudi riyals, including most of the GCC currencies. So for a project which is transportation, a utility, a hospital, a school, where the revenues are in local currency, the fact that we can support borrowing in those local currencies means that there isn't a currency risk that's brought in. I know we're a bit different because of the peg here in the Gulf, but nevertheless, you don't have that basis differential in terms of funding. Your revenues and your debt can be in the same currency. So that is the remuneration that gets paid to the bank. They administer the loan. They are the agent of the loan. All the reporting goes to the bank. And as a borrower, you've chosen that bank anyway. So it's likely to be a relationship bank that you already have. So that's a convenience. Most of these financings, I should say, are done through international banks. That's for some banking reasons. We would love to do transactions with local banks. We would love to do it with UAE banks. And in that same change of the OECD arrangement from July 2023, there was introduced a currency discount factor. So hasn't been used yet, hasn't been used here in the region. So if there was a borrowing in dirhams, the part of the pricing that I'm about to talk about, which is the exposure premium that comes to us, then that can be discounted in relation to the country factor of the currency. And this is the OECD trying to promote the growth of local currency financial markets. So in places such as Singapore, places such as the UAE, strong, deep financial markets, there is a lot of attraction, to my mind, for looking at a local currency financing. I'm very keen to see us do the first one. So the exposure premium. This is what we charge to cover our cost of operation. Now, we're a portfolio risk taker. And so as with any portfolio risk taker, we build in a small element of expected loss. We look at what is the chances, of that facility going bad. what are the chances of not making a recovery in the event it goes bad? And so there is an expected loss calculation that's based upon the country of the risk, the nature of the risk, and so on. So we price that in. And if that loss doesn't happen, then we make a small gain at the end of the year. But it is not a profit per se. We return funds to the UK Treasury. They like it. We're probably the only department of government that gives money back to Treasury most years. So that's what we charge. So let's look at a real example. So if you were to look at a project that has 2-year construction and 10-year repayments in the UAE currently, then our exposure premium for that is currently 2.71%. It's on our website. You can go and look at you put the availability period, 2 years in my example, the repayment period, 10 years in my example, the country, and you get the answer of 2.71.
It's just important to know this is not an annual premium. It's
This
just
is
a one time.
This is a one-time. However, if you borrow from a bank 100 and they charge you 3, let's round it up for ease. If they charge you 3, day one you get 97. So they've taken their fee up front.
Mm.
If you're borrowing under a UK Export Finance guaranteed facility, you borrow 100, day one you get 100. In fact, you draw it down over the availability period, but you get 100 effectively. And the 3 fee you repay over the repayment period. So in that example, over the 10 years, over the 15 years,
Can
over
be part of the loan.
it is added to the loan. So you implicitly borrow 103 and you pay the 3 fee in cash terms over the life. So that has an IRR benefit. That has a cash flow benefit to the company. So that is a difference from borrowing on an ECA supported facility. Different countries, different risk profiles. Clearly the fee is different. If you look at the UAE, 3 years construction and 15 years repayment, the exposure premium comes at about 3.7%. So when you look at that as a cost, what you would typically do would be to then look at that over the average life of the facility. So coming back to the easier example, 2 years drawdown, 10 years repayment, let's assume straight line, average life is 6. So you take that 2.71%, you divide it by 6, so it's under 50 basis points per annum. You add that 50 basis points per annum to your 1%-ish margin. So your all-in cost of funds is around 1.5%. Very simple. That's what you'd have to compare with an ECA supported facility to whatever you may be able to get from elsewhere.
Yeah, that's exactly what I was trying to focus on, and you nailed it to the T. I mean, because when, like I was mentioning you before the episode, whenever I had these discussions with other treasurers who might be aware of the ECA or not aware of the ECA, but or maybe they don't have the knowledge, maybe didn't experience it, they don't see how cheap it is versus, yeah, you need to go through the process, you need to go through being eligible for it, but you will love it after you get through it because of the cost, because of the tenor, and the banks love it. Because as you mentioned, the banks would love to go for an ECA because they are 85% guaranteed.
85% guaranteed. The banks love it also because risk that they take to OECD governments is generally 0 risk weighted on their balance sheet. So when you look at the capital adequacy ratio, which is the all-important ratio for banks, when they're getting revenue that's coming in, but not booking the asset in terms of risk weighting, it's 0% risk weighted, their risk-adjusted return on risk-adjusted capital is boosted through these transactions. So the banks are very hungry for ECA guaranteed transaction paper risk profile. They also tend to wrap it up and sell it off to insurance companies and pension funds as well. So they make money booking it, they make money selling it. And when they're holding it, well, there's no such thing as free money. I'm saying this as an ex-banker. But it's an attractive proposition for the banks. It's an attractive proposition for the borrower. And it's an attractive proposition to the ECA, to the government, because what it is doing is encouraging exports from the country. And that's what it's all about. And so there can be a perception that it is difficult to find the exports. But I think the examples that I've given show that for different sectors, different industries, around the world, in this part of the world, it's been mostly construction, but then look at Dubai over the last
Mm.
10, 15, 20 years. But renewable energy, rail, I'll give some examples in Turkey. We've done 3 large high-speed rail projects in Turkey, where and we've also done the Cairo monorail project. And in total, there's $6.5 billion worth of support to rail projects, where we've achieved the required content from the UK going into those projects. So different countries, different industries, different types of projects. The only thing that we cannot do, and this is by UK government policy, is oil and gas. We can't do upstream oil and gas. We took a decision in March of 2023, just ahead of COP 26, that we would no longer support the extraction industries, oil and gas, and some mining as well. So other than that, we can support all industry sectors. And the tenor is attractive, the cost is attractive, there's a bit of a hidden discipline that comes with it, and you get access to the high quality UK supply chains as well. So if your project ambition is cheap, you're buying a project build to sell, you want to build it, sell it, get out of it as quickly as possible, you're probably not going to be buying from the UK. There are probably cheaper places for buying the content for your project. But if you're buying an asset that you care about, it's going to have your name on the door. It's going to be operated by you. You're worried about maintenance. Let's take a hotel as an example. If you're staying in a hotel up on the 20th floor and the lift doesn't work, you're going to get upset pretty quickly. If you don't get hot water, or probably more importantly, cold AC coming out, you're going to get upset pretty quickly. So if you care about the quality of your asset, you want to have minimum maintenance, you want to have minimum replacement cost, you want longevity of your asset, then you're going to buy probably from UK, from Europe, from America, from Japan, from countries that offer the higher quality generally of products. I'm not, dismissing others. There are other new competitors as well, but you're going to be buying in that space. And therefore, you have to look at the total life of asset value of what you're procuring, taking out the maintenance costs, taking out the replacement costs, and looking. So there's an easy complaint, rightly or wrongly, that UK might be expensive. And depending on the nature of your project, if you want a cheap project, yes, it might be expensive. But if you're developing a quality project, if you're looking for quality procurement of assets or whatever you're buying, then there is a level playing field in that space, and the financing can make a difference. And this is where I think the fact that the UK export finance, we're a AA rated country still, and the price at which banks price the UK export finance guarantee, it's a guarantee, it's 100% guarantee. Some of the European ECAs don't do 100%, they do 90 or 95% guarantee. We do the full 100%. We take documentation risk on the buyer credit guarantee. Not all ECAs do that. And there's a difference between a guarantee and an insurance product. If you claim on your insurance, it doesn't get paid quick. If you claim on a guarantee, it's much more likely to get paid more quickly. And that's where the banks like working with UKEF. We have a low threshold, 20%, as opposed to 30% for most of the Europeans, or higher for the Americans. And that's why I think we've been successful in the number of transactions that we've done. And if you look at the sort of rankings of export credit agencies, not necessarily on volume, because we don't look to do the most money. We're not trying to lend just for lending's sake. We don't have an untied facility. We only have facilities that are directly related to current exports from the UK. And that's what the government is there to support.
I think this is worth to mention because I'm aware there is a minimum value of the project that you're going through for you to be eligible to the ECA. I think we didn't mention that.
There's a minimum practical value, and it's not that we set a minimum. It's the practical value that is set by the banks, because the banks don't necessarily want to do an ECA transaction, which may be slower, it may be more documentation heavy, for $500,000 or $1 million. It's probably uneconomic for the bank, and you'll struggle to find a bank that's willing to do that.
Yeah.
So the practical purposes, the buyer credit that we've been talking about would typically be about $30 million or larger. But there are a lot of projects that fall into that space here in the Middle East. But we do have something called a standard buyer loan guarantee. For want of a better phrase, it's a buyer credit light. So it uses standardized documentation off the shelf rather than tailor-made to the project. Standardized documentation with, again, for simplicity, a sort of one-pager that are the terms and conditions of the particular transaction. And in that case, we've seen transactions come down to around $3 to $5 million. And in certain circumstances, the advantages of the tenor, the advantages of the pricing, and perhaps a different group of lenders. Some of the big international banks maybe don't want to do a $3 or $5 million transaction, but there are some other banks that do want to work in this space. And there are some non-bank financial institutions that work with us as well in this space. They like the fact it's quick, it's standardized documentation, and they can do a flow of business and diversify their risks on the transactions, win clients, more clients than just a single large client that is already being overbanked perhaps by the big international banks. So there are different answers to the type of clients that you're talking about and you're talking to, and it may not be one size fits all. I mentioned two toolboxes at the beginning. It would be remiss of me not to mention the supplier credit toolbox.
Of course.
Dubai is a hub. It's a hub for the UAE, maybe. It's a hub for the Gulf. It's a hub for MENA. It's a hub increasingly for Africa. It's a hub for Asia. And so there are a lot of companies here, UK companies here, that are trying to win contracts, sell their goods, sell their services into all of those geographies. So one of the challenges that those UK companies face might be bonding. They're asked for bid bonds. They're asked for performance bonds. They're asked for retention bonds. So we can amplify their bonding limits. They working capital. They have a bigger order. They have a longer supply chain selling to the Middle East than maybe France or somewhere. They're going to collect that money later. They need help with working capital. They need funds to invest in their business. They're selling a product very strongly overseas, and they need to double the size of the factory or set up a business development or a marketing hub in the UAE. Then for whatever reason, they know best how to invest in their money to grow their business. We offer supplier credit products that enables us to support 80% of a transaction. So we can multiply the limit that your bank gives you by 5. So they give you 1, we'll make that 5. The bank still takes the 1 risk. For bonding, for working capital, for funds to invest in growing your export capabilities. Or if you don't need any of that, but you're simply worried about being paid, we have an export insurance product that supports up to 95% of the contract value. So if we take on that risk, then you can be confident as an exporter from the UK that you're going to get 95% minimum of your contract value. So I just wanted to mention those supplier credit products because I was surprised moving into this job. I expected mostly to be talking buyer credit, as we've done today. But because there are so many UK companies choosing to make the UAE their home, their hub, whether they're in Abu Dhabi, whether they're in Dubai, Ras Al Khaimah, or elsewhere, then the conversations I'm having are about helping them, having found the lead, how can they financially deliver that lead? How can they deal with the supplier financing challenges, bonding, working capital, etc., export insurance? And so we've got the products that support those as well. That wasn't always the history of the ECAs, coming back to where we started, but we've evolved to address the markets and we've evolved to address the needs of companies. And those supplier credit products especially are focused on SMEs. We have 2 positive priorities. One is climate change and the other is supporting SMEs. So if you fall into any of those categories and you perceive that export credit could be an attractive financing solution, then consider buying from the UK. We can help you find that content, the goods, the services, the intangibles that we mentioned earlier. And then we can have a conversation about how UK Export Finance can help. Again, I know this is non-country specific, so it's just also mentioning that other countries have similar ECAs, repeating that.
Mm.
And again, if you're a treasurer of a UAE company and you're selling overseas from the UAE, then you've got your own local export credit agencies here. Etihad Credit Insurance, which is the national ECA of the UAE, and you've got Abu Dhabi Export Office, a particular unit as part of Abu Dhabi Fund for Development that also supports exports from the UAE. And it would be wrong of me not to mention them as well.
No, I love it. I mean, I've been through the ECA for more than twice, I think maybe 4 or 5 times. And trust me when I tell you, Graham, I have learned a lot today, even though I went through this before. It's been very, very interesting. I really loved it. I think you were on point. It was very, very clear and I loved it. I've learned a lot today, Graham.
My
Thanks a lot for
pleasure.
being here. Thank you.